So Newquest seems really committed to the traditional grocery anchor model. And yet Amazon is coming in with a new concept. So how do you see Amazon and traditional grocer? What's the future of that?
We've never been a infill type developer. It's different for us. It's complicated. Midway seems to have mastered it. It's expensive, and I do think that the market's going to continue to see more of that. Jonathan's going to announce a deal here in the next 2 weeks that's going to be more of that right up here off the wall, and so we have stuck to the suburbs, and I don't think that's going to go away. I mean, I do think that the rooftops continue to grow, the sprawl of Houston is going to continue, but I do think the infill will continue to need to be, the grocers will get very, very, very conceptual. Parking garages, I mean, 10 years ago, if you said a grocery store is going to have a parking garage, I don't think that concept is beyond us. So we will continue to do traditional development in the suburbs, but the infill will happen. It'll be repurposed, buildings will be torn down, more stuff like you'll see at Midtown, where Jonathan's about to build, and stuff you've seen in the Heights. It's going to be more and more of that in the infill.
So Jonathan, related question. So your mixed use has not had grocery before?
Correct. Yeah, I think, dovetailing what Alan said is if you step back, I mean, the grocers need to be everywhere in Houston, right? So, they need suburban locations, they need urban locations, and as Houston densifies, I think they all realize they need to figure out how do I service the customer in the urban core, which is tricky. I mean, Whole Foods is willing to go down to 30, 40,000 feet to do an urban deal. Kroger's and H-E-B's and others have said, no, we still need, to service our customer correctly and deliver the product we want to deliver, we still need an 80, 90,000 square foot store. So trying to do that in the urban core is tricky. We don't think grocery's going away. I don't know if y'all have used H-E-B's new to-go service, but I think that's where you're starting to see the bricks and mortar retailers kind of merge towards some of the online stuff. And so those of y'all haven't used it, it's you basically go online at H-E-B, fill up your shopping cart, and you show up to the store 4 hours later and they put it in your car. It's fantastic. And talking to them on how people use it, it's interesting because what they're seeing is a lot of people shop online for what I would call the basics and get that stuff put in their car, but they're still going into the store to go through sort of more of the experiential part of the store with the bakery and the meats and those kind of things. So I think they're trying to deliver the best of both worlds, which is pricing, convenience, and an experience.
Jonathan, focusing on the office market, what factors do you see kind of help mitigating the delivery of the new supply you spoke about, and how do you see that playing out?
I'd rather talk about groceries some more. But, no, well, the one thing I didn't say was the sort of silver lining in all of the data was there was probably another 10 million feet of buildings that were either announced or thought about getting built that didn't get built. So if oil prices had dropped a year, 18 months later, I think a lot of those buildings would have broken ground. So instead of having, a 20% vacancy, we might have been able to put on another 10 million feet and had 30% vacancy. And so, in a way, that's good. The market reacted quickly, clamped down. So from a Houston standpoint, capital's not very excited about building office. From a macro standpoint, I mean, construction lending is really difficult, not just for Houston, but the banks have a lot of regulation. It hits their capital reserves really hard. And so I think those two factors, you're just not going to see a lot of office get built, which is good. And, depending what our absorption rate is, where it's going to take us probably 3-4 years at a minimum to kind of start working through some of the vacancy and sublease we have.
John, I think it had been not too long ago, people would have not thought of Baytown, Texas as a development hub. Why Baytown? I know you touched on it a little bit, but.
Right. So we've had a lot of plant expansions up and down the coast, and a lot of them are the plastic resin industry, polyethylene, polyurethane, the little plastic balls. They're what makes your sunglasses, your reading glasses, your cell phone, cups, anything plastic. And the dual service that Baytown allows, which is dual served by the B and the UP, has provided, in land for that matter. I'd love to challenge everyone down here, not that y'all care about industrial, but to go find rail served land in the Port of Houston. It's virtually impossible, or it's restricted, or the railroad won't serve you if you don't have a 6,000 linear foot tail track to get the main train off to get one past. It's just very difficult. There's huge barriers to entry into rail. And the Baytown Cedarport facility offers users the ability to go buy 100, 200, 300 acres to build these massive plastic resin plants where there's some manufacturing, a lot of plastic packaging. You'll see the transload facilities behind these buildings that vacuum the plastic balls out of the rail car into the warehouse where they're packaged, sent to the front, and shipped for export to anywhere in the world. And that's a huge business for the Port of Houston. So Baytown offers land, available land, dual service, you're not held captive by rail, incentives. I mean, incentives are huge. IKEA, Amazon, I think Amazon was the first one to come into the city of Houston and get incentives. Houston is not, incentives forward thinking, because I think you're going to see the big box, if it does happen here, related to e-commerce, it's going to be outside the city of Houston, not necessarily in. So Baytown has those three things: incentives, dual service, and available land.
We can ask our city controller about that.
Yeah.
He probably knows a lot about the Amazon deal.
Jonathan, I promise you, last question about the office. So you touched on this a little bit, but just maybe share with us what kind of trends are you seeing from a tenant perspective as they analyze space and how they're trying to utilize space?
Yeah, I think the macro view or sentiment is nobody's leasing space, and that's not the case. I mean, if you take kind of energy out of the equation for a while, and I think it's great. Energy prices are back, and hopefully they keep going. I don't think we're still going to see any rapid expansion in employment on the energy side, so I don't think the office space is going to snap back from an energy demand perspective. So, but Houston is filled with a lot of companies that still have lease expiration, still managing their business, and figuring out how can real estate play a role in running a great business. And so, I think we still see a trend of people thinking about today leasing not just space as a utility, but what does it do for my brand? What does it do for my employees in terms of attracting and retaining talent? So we very much see those trends. And so if you look across our portfolio, where we're not trying to lease blocks of 100,000 square feet, we're leasing probably on average 5 to 30,000 square foot deals. Those tenants are still out there, and they're having to figure out what to do. Now we're all having to maybe compete a little harder for those, but again, I think you get a differentiation in landlord mentality too. Some are willing to sort of chase rates down, and some are willing to say, you know what, we have a good product, and we're going to hold rates. And so, but there's still plenty of activity out there. It's just we lived so long on big block energy deals, right, where people were going out and leasing 200,000 feet, 500,000 feet, and that just doesn't exist. But you are seeing some people move around to the extent a big block tenant has a need. Now's a hell of a time, right, to go strike a deal. And so, you look at, say, Shell, moving out of downtown. They just announced that. So One Shell Plaza is basically going to be vacant with some pretty good term left on the sublease. So if you're a big user, you could probably go, get a pretty attractive deal in a fantastic building. So,
Alan, what is the impact of our new president and his policies toward? How's it going to affect the real estate business?
Well, for sure, he's overriding things. I was there last week, and you can't walk by there without either protester or camera wearing you out. It's very active at Trump Tower right now, and my guess is we're going to see a drastic overhaul in the IRS code. That's going to affect a lot of things. I met with quite a few investment banks up there when I was there, and it seems that they're really focused again on doing away with carried interest in some form or fashion. Hopefully not in our business, but more in the hedge fund, Wall Street guys. That's one that would affect our business drastically. Secondly is the 1031 tax-free exchange is on the table to be chopped up, which would really affect our business highly. I do think that his administration and his really focus on deregulation, pulling down some of the regulations this last disaster created, is coming probably, they'll make some headway, not a lot, but probably in the banking industry. But it's created obviously, if you follow the 10-year, it's moving. It's moved 80 bips in probably 3 months, and probably got another bump this month, and we'll see another 75 or 100 next year. So that's going to pinch it, and that administration is bullish on business, and it's going to run. So in our business, all three of our businesses, it's interest rate sensitive, cap rate sensitive, where we model our exits, where we model our free cash flow based on if we have construction dollars and where those interest rates fall, can we outrun it with a little bit of inflation? And so I don't know. I mean, I don't know the total answer, but it's going to be different next year for sure.
So where do all three of you see interest rates going? Everybody's going up.
I say it's up 100 bips in 15 months.
Yeah, it's interesting contrast. I think Alan said it right. We're gonna, I think, enter a very pro-business environment, which should be good for real estate. We're probably gonna have inflation, which is good for real estate, but I think a lot of that's gonna be counteracted by growing interest rates, and then I think the tax code is huge. I mean, it could have significant impact on how real estate's valued. So.
Yeah, I'd say one thing, as we model the build-to-suits, which has been a lot of the construction and absorption we've seen across the country, is with low interest rates, it provides for lower rental rates. So when you're trying to attract that tenant out of a current facility into a new, and you can do it at a lower interest rate, we probably build to Mary would know better, probably a 7.25 here, and if you go to Inland Empire, you're probably at 4.25. And Alan mentioned your exit. What can I sell it for? Where am I? How much am I covered? What's my risk? So it's very, very important in all of our business, especially for new construction.
I will, and I'll just highlight my comment. Construction lending, I think, will really hold the supply side in check. So I think that's going to be good generally across the country for rates and occupancy. It's just going to be a lot tougher to get something built.
So John, last couple of years of this program, the person in your chairs talked about the Panama Canal expansion. So give us your view on kind of how you see that playing out for the Houston market as well as other ports along the Gulf Coast.
Sure. This is my opinion. So how the trade works is manufactured over in China, and there's shipping routes, right? So to ship from China, Shenzhen port, or any other ones is about 26, 27 days to LA Long Beach. It's about 25 to Seattle. Coming through the locks, the Panama Canal to Houston's about 33. Then you get to 34, 35, 36 up to Newark, New Jersey, New York. What I see for Houston, the Panama Canal is probably not a lot. I think it looks good. It's a good read. It's a good story. I think we'll see increased traffic from shipping lines, and it's really from diversification, from product getting manufactured, shipped, transported, delivered on the shelves. If you're a Toys R Us, for instance, and you're buying tons of toys, you want to diversify. You're going to send some through LA Long Beach. You're going to send some to maybe Houston, Savannah, Baltimore, New Jersey, New York, and then have it come into the United States. One issue with LA Long Beach, which is the largest port, is you have to ship it to LA Long Beach, rail it to Chicago, and then rail it into its final destination. So it's really a diversification. One thing that I did learn is the Panama Canal cannot handle the post-Panamax ships, so they cannot handle the larger ones, but they can handle larger than what the other vessel locks would allow for. So I thought that was an interesting, they've spent billions of dollars and they can't even get through the larger ship that they build. So I'd say slight increase.
Let's talk about e-commerce, how it affects all of your businesses and how you see it growing and the impact it's going to have on your businesses going forward. Somebody start.
I'll start because it goes like this, kind of, because that's the way. It hurts us the most and helps him the most. So
I can't wait.
the clicks are 10 years ago. It was kind of out there discussion. It's definitely elephant in the room now, and we're seeing it a lot. Like I mentioned before, where groups like Academy are lower. They're doing just as much volume out of less space because of logistics, and that's still related to e-commerce because that's become computerized. But you're seeing more of the click guys come into the retail space lately. Amazon putting bricks and mortar stores up, but it's definitely it's kind of like watching a ship in the oceans move. It just doesn't look like it's moving very much, but then you look back over a year or two or three and it's taking a hit on us. It will affect us. It will flatten us. We'll have to get smarter. But overall, the retail development numbers will flatten out because of e-commerce for sure. Over on our sales on a per square foot basis of our tenancy across the board, mom and pop sales are a little bit hard to get, but for our national credit guys, it is really not quite affected it yet. It seems that if they're the national credit guy and they bought something online and they can return to the store, it still creates a market, and that's still happening now. Now, the eBay stuff is a little bit different because those are more shopper to shopper. There's no return there, but so far it's been pretty flat.
So a couple of thoughts. So we'll take a survey. How many of you buy things today that you never would have bought had you had to go to a store, but because you can get it online, you buy it? Right. So I think in one aspect, online sales are not necessarily dilutive. They're actually growing the pie. I mean, I think about the things I buy online, and there's no chance I would ever have spent the time to go to a store and bought it. And so there's that aspect. I think it is growing the total sales pie. I think if you look at the retail world, from an investment standpoint, we sort of look at two ends of the spectrum. There's price and convenience, and there's experience. I think largely price and convenience is going online because those are sort of more of the commodity buys, and then there's those things that you want to go to and you want to experience. And like I said, I think H-E-B is brilliant, and they're one of the few who's actually, I think, bridging that gap pretty effectively. The other phenomenon, and Alan said it, is we mostly deal with lifestyle retailers. If you think back to the beginning of lifestyle retailers, they started as catalog sales, so the Pottery Barns, the Williams-Sonomas, right? And then they had all the sales data from where their sales came from, and they came and opened stores. And now I think you're seeing the same thing. So you got the Warby Parkers of the world that started as an online business. They know where all their best sales come from, and now you're starting to see them open stores with that sales data. So it's going to be an interesting, retail is a brutal environment. I mean, it is the most competitive space, so it's going to be fascinating to see it unfold.
I'd say a clear-cut sign of where we're going is I have a 5-year-old that started playing flag football this year, and he goes, "Daddy, let's go to Academy." I said, "Great, let's go." Get the keys, walk downstairs. He's following me. I get to the back door, and he goes, "Where are you going?" I said, "I thought we were going to Academy." He goes, No, on your computer." And I was like, "Okay, we can do that." Opened it up, fired it up. He's surfing around, looking at different things and wants the Cam Newton Nikes, and we buy them. And it's one of the things we're seeing in our side is the Amazons coming to Houston. Everyone's chasing Amazon. The next hour, the same day delivery. They're all trying to follow that model. So we're seeing from a development side is you might have a large DC in Dallas, but you might have a 200,000 foot, 300,000 foot in a smaller city, and it's called a fulfillment center that you click, they box, pack, and deliver. So it's a great trend for industrial development, distribution centers, and obviously we hope to get in the front of a few of them as we go forward. It's definitely the wave of the future.
So ultimately, it affects everything we're doing. Right?
For sure.
Everything we're doing. We just don't know quite how far it's going to go.
The high end, I think, really is pretty protected, and as long as there's women with shopping credit cards, there's going to be plenty of people in stores.
My wife appreciates that.
I know. We'll keep them open for them.